All right, Emily, what are we talking about today?
The responsibilities and the pros and cons of being executor of someone's estate, what to look for in home and auto insurance and when it's time to shop around, and considerations of when you sell your home and decide to rent rather than buying a new home.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so I follow the intent of the question here, but you realize I'm not an attorney.
I know, but you know a lot about everything, and oftentimes when I ask you questions, you still have a pretty good idea.
This feels very ultra crepidarian to me.
I have a lot of questions, and you always say I can ask whatever I want, and if you don't know, you refer me to someone that does.
Oh, fair enough. All right. Well, I guess the disclaimer here for everybody listening, obviously, I'm not an attorney, so I'm not answering this from a legal perspective. But we do deal with a decent amount of estate planning. And as a consequence of that, that means we're also often quite involved in the outcome of estate planning, being helping the survivors of our clients or family members of other people who then become inheritors or executors of their family members' estates and helping them figure out their assets and so on and so forth, and kind of how they're going to deal with that or how they're going to settle an estate. So I guess talk to me about what your actual question here is.
Well, this one stemmed from my personal life, actually, and less so from a client meeting question. We certainly deal with it at work, but somebody in my life asked if I would be willing to be the executor of their will should something happen to them. And I said, oh, yeah, sure, probably. We can look into that. But I brought it up to you at work, and you said, oh, be careful. There's some things you may not be aware of with that. Um, so I guess I don't really understand what kind of liability and potential costs I might be taking on if I did agree to that.
Sure. Liability is probably not the biggest element here. I do think costs, both financial and then just time and opportunity costs, can be pretty substantial. So, first and foremost, I think to put everybody's mind in the right frame for thinking about this, here's a thing to role play for yourself. And you can do it literally, or you can actually, just kind of imagine it for a moment. But if you were dead right now, or if your partner passed away right now, do you know where everything they own is? Do you know where all of their assets are? Do you know how to access all of their accounts? Do you know what their intentions are? Do you know what the nature of their assets are? Do you know what debts they owe? Do you know what liabilities they have? That's just sort of the setup framework. And in turn, again, if you're thinking about this just for yourself, when you think about who would take over in your case. So if you don't have a will or if you don't have an estate, this might very well be a parent or your spouse, or if you're older, potentially, if you don't have a surviving parent or spouse, this might be one of your children. But really take a moment to think about all the good practices you have around your privacy and security, right? The fact that you don't just like shout from the rooftops where your bank accounts are, the fact that you have maybe a password manager or multi-factor authentication on your accounts, that you have paperless delivery of all of your account statements instead of getting stuff in the mail. All of those good behaviors become a hurdle and an obstacle for somebody who becomes an executor. So, Emily, in your particular case, thinking about who this person might have been asking you to be their executor, the intent is good and the ask is genuine and honest and frankly a great compliment because they're saying, hey, if something happens to me, can you take care of my affairs? But realistically, a ton of people are very unprepared, even if they do have estate documents, for the actual burden of what it takes to be somebody's executor and personal representative. You are going to, depending on how organized they were, how well communicated they were, you are going to have to go to countless financial institutions, legal businesses, through courts potentially if it's going through probate, and you're going to have to jump through hoop after hoop after hoop after hoop after hoop in order to do something as innocuous as closing out a old savings account at a credit union from 30 years ago that has $5 in it. It is a ton of work to be somebody's executor and their personal representative. And that's just the work part of it. That's not even getting into the family dynamics of who is getting what.
Right. So Is it better to, before you agree to it, maybe say, can you simplify things down and get it organized and then I'll be the executor? Or that's not necessarily the way to go. And you should just say, I don't know enough detail about your life. Maybe I don't want to do this.
I think there is a chicken and egg problem here. Everybody should have a will or a trust or a combination thereof, and the various other items that go into an estate package, like medical directives, HIPAA releases, instructions of guardianship for their children. Like everybody who doesn't have that listening to this, go get your estate stuff done. Do not procrastinate it. Thousands of people, tens of thousands of people die at random in the United States every day for completely unforeseen reasons. So I'm just going to say this to the audience right now. If you do not have an estate plan or package and documentation done, go get it done. And if you haven't had it done in years, but you have one from like 20 years ago, dust the thing off and go review it and see if it actually still applies, if it's still appropriate. That said, to your question, the typical answer here, and I think a good estate attorney is going to help with this quite a bit, is you need to get your documents done. And as part of your documents, you want to have some consolidated instructions. Hey, here's a list of where all of my accounts are, all the institutions, the appropriate account numbers. And you're not just like, putting this on a little folder on your coffee table that should be kept very securely in a safe or something like that. But then you should be very directly communicating with your executor. Hey, when I die, this is where that information is. Here's the law firm that did my documents. Here's a soft copy of my documents. Here's everything that I need to give you for you to have a very clear picture of what my estate is and where things are. And then it behooves you to try to check in on that pretty regularly. Hey, I became your executor a year or two ago. Have you opened any new credit cards? Have you opened any new bank accounts? Have you changed jobs and gotten a new 401k? Like you've taken on this obligation to stay current in this person's life, essentially in perpetuity until they or you die or you give up this responsibility, because anything that they don't document for you is going to become something you have to go find later, and later can be over the span of months or even years, case by case.
Hmm. Is there a difference? The person in my life that asked me to do it is not a blood relative, but if I was, is it more complicated? Because in that instance, I might stand to be inheriting something from them, and then there's a conflict. Can you still be involved in the process?
I think this very much gets into legal advice, so I'm going to be very general here. I think it doesn't really matter so much if this person is your blood relative or family or not. From my perspective as a financial professional, could there be statutory reasons where it's more or less beneficiary or beneficial, excuse me, to be somebody's executor if they're family versus not family? Potentially, but that just gets into an area of law that's way too deep for me to be able to really opine on. I do think, in terms of whether you're a beneficiary of the estate or not, that is a conflict of interest, and that is something to be careful of. I think ultimately, when somebody accepts this responsibility, if there are any other beneficiaries, right? So if you're like the eldest child of three children or something like that, then you have to be very thorough about documenting what you do and how you do it. Many wills and trusts will come with a clause that essentially says if anybody kind of throws a bitch fit about this, they're excluded from the will. So don't start shit. That does not stop people from starting shit, because it's a zero sum game. In that particular case, if they think you're mismanaging the estate, or if they think that there was undue influence upon the person who passed away before they passed away, then they can make a case in court, and that clause only kicks in if they lose. Right. And so if they feel like they've been disinherited or they've been carved out in a way that they didn't think was appropriate, where they're going to get nothing, or they're going to get, $5 instead of $5 million, they effectively lose nothing by starting trouble. So in terms of being the executor, it does behoove you to act with the utmost integrity to keep things on the up and up. Many wills and trusts will prescribe that the executor or the successor trustee can be paid for their time. But this is where, again, you do need to be very conscientious of doing things appropriately. There have been many famous cases where, for example, celebrities have passed away. I know Prince is a good example of this, where essentially corporate trustees came into the picture because the estate was not well structured or was completely unstructured, where the estate has essentially been bilked for millions of dollars by these third-party vendors, who I would argue are probably not acting with the greatest levels of integrity, but they're just sort of milking the estate instead of getting things done efficiently for the benefit of the heirs and the beneficiaries of the estate.
Hmm. It's a lot more complicated than I realized. Good thing I asked.
And here's the thing, I think it's a great privilege and honor to be asked to do it. It's just not a responsibility to take on lightly because A, you don't know when it's going to happen. B, you don't know how complicated it is at face value. And C, at the end of the day, once they're gone, you can't ask them for feedback. Right. So it's not enough to just say, sure, I'll do that for you. I do want to emphasize sort of the lifelong necessity to stay engaged with this person or with this family and to have a clear understanding of what their estate instructions are, that their documentation reflects those instructions, and that you're very clearly aware of how to get access to their assets, their liabilities, their financials, and so on when that time comes.
Hmm. Good checklist to have. Okay. I have another separate question about a totally different topic, but also from my personal life.
All right. Well, your personal life is full of interesting questions, so let's go for it.
Okay, well, I have relatives that live in South Dakota, and they've been texting me this week. They got a huge hailstorm, like baseball size hail. They lost, the windows to their cars shattered, their roofs are all ruined, and they lost one chicken, which got me thinking about insurance. The chicken's already gone, but we do deal with insurance a lot here with our clients. We'll reshop for them if they're possibly overpaying and provide advice on that. But we've had a lot of hailstorms here in Colorado, and I know our rates here have gone up in general because it's kind of been an ongoing issue. We keep having these big hailstorms. Are the rates going to go up in South Dakota because they've just had the one huge one, or does it have to be recurring like it is here?
So this kind of goes into how insurance is structured, and something like home and auto, generally speaking, insurance carriers are going to have risk pools. These are often defined by city limits or zip codes, sort of how they cluster together their policy holders for the purpose of assessing the level of risk in that area. If there's one singular sort of freak event that causes a lot of damage, you might see a bump in individual rates simply because of the loss that's been accrued to that pool of policyholders. But it really just depends on how widespread the damage was, how big the claims are. Here in Colorado, we are starting to have this repeating issue where it seems like every couple of years there's a major hailstorm that breaks every other roof on every other street in multiple cities. And so even though the cost of that is borne by multiple insurance carriers, their larger risk pool here in Colorado is often getting hit across the board where they're not taking in enough money to cover the claims. And so functionally, policyholders from elsewhere in the country or other parts of the state are helping pay for those claims. And that's how insurance companies function. But from a underwriting standpoint, the more frequently an event happens in a select geographic area, the more likely they are going to be to increase their premiums to cover for that. And we've seen catastrophic versions of that in places like New Orleans, Florida, and kind of areas in the Gulf Coast where hurricanes have become more and more frequent over the years, and the claims are very, very expensive, and the flooding is very, very expensive. And so we're seeing premiums, literally double year over year over year in certain parts of the country because the insurance companies are willing to stay in the marketplace, but they're getting hit by so much or rather, so many claims within that risk pool that the only way for it to make business sense is to increase the premiums enormously.
Oh, well, okay, that makes sense. How often do you recommend people shop around, though, regardless of things happening? Because rates are always kind of changing anyway. Is that, I just feel like most people in my life, they get an insurance company and they stay with it forever because it's easier. Is that wise?
No, generally speaking, not. Carriers will make a really big deal about like loyalty discounts. Yeah, you've been with us for 5 years, you get a discount. You've been with us for 10 years, you get a discount. And those discounts can be valuable. I'm just very, I'll say, bearish on the element where those discounts actually make up a difference. It is not uncommon that we see clients who are paying an extra thousand, $2,000, $3,000 a year for just their basic home and auto policies, as well as sometimes carriers don't do a very good job of adjusting for inflation. And so you might have had a carrier for your homeowner's policy for the last 10, 15 years, and they've been inflating your dwelling coverage a little bit at a time, year over year over year, but they have not looked at your property and assessed it in an underwriting sense to understand whether or not it has increased in substantial value and substantial replacement cost value. in that time since, where not only will we see customers potentially paying, again, one, two, $3,000 extra a year just because they've been with a carrier for a long time, but also they might be grossly underinsured. I'll give you a very recent example. Somebody came in with really, really high homeowners premiums, about $4,000 a year in homeowners premiums, a couple $1,000s in vehicle premiums. And when we went to go shop for replacement coverages, we ended up finding auto policies that were something like $1,000 cheaper, or I think it was even closer to $2,000 cheaper a year. But in turn, their homeowners policy, by comparison, that we were getting back from carriers, they were quoting a difference. We're coming in about $1,000 more expensive than the homeowners policy. But the key distinction was their existing policy was only covering about $500,000, when in fact their property would have cost something more like $700,000 to $800,000 to rebuild. So we saw a jump in premium when we did a comparison, but there's also an enormous jump in the amount of coverage this person's being provided with. So to your question about how frequently or how often, I don't think people should sit with their carrier really any longer than about 2 to 3 years without at least shopping the market. That does not mean you have to change coverage. That does not mean you have to make a move. If you could save $1 by moving to a different carrier, there are switching costs. But I do think it behooves people to really critically assess what they're paying and to make sure they are well aware of what the marketplace is for coverage on a going basis, because it's very, very, very common that we see somebody who's been with a carrier for 5, 10, 15, 20 years overpaying by a substantial amount or being underinsured by a substantial amount, or both.
Does this kind of tie into? I hear you a lot in meetings. People will have, a good insurance policy, and that's great, but then their lives have changed, and you often recommend an umbrella policy, and they didn't have one in place at all. That's kind of how frequently do you see that in your meetings, I guess, because a lot of people have a good homeowners and auto and they think they're set, but they're missing a whole separate policy.
Oh, first and foremost, let's just explain what an umbrella is. So, an umbrella is a additional layer of liability protection that sits behind your home and auto policies. So, a typical homeowner's policy that we see here in Colorado is going to have $300,000 of liability coverage for something like a slip, trip, or a fall on your property. It can also extend to certain other off-property events, but that's a separate topic. And then often in auto policies, I believe the state minimums are only $25,000 per person and $50,000 in the aggregate. Most often, we'll see somebody who has $100,000 per person and a $300,000 in the aggregate. And the trick is, those numbers have been the same since I started doing this about a decade ago. And I suspect those numbers have not moved a lot, even in many of the years preceding. So when we think about that, $300,000, let's say 10 years ago, was $300,000. $300,000 today, in terms of purchasing power, or its ability to protect you in liability terms, might be closer to $270,000. So even though the dollar amount seems big, we have to remember that the value of the dollars is changing. The second thing is just to really think for a moment about how much damage you can really do in a very short amount of time. So, imagining the scenario where you just do something as innocuous as rear end somebody, they brake a little too hard, you were driving a little too fast, and you rear end them. And here's the question: what was that vehicle or that thing that you rear-ended, and who was in it, and what happens to those people? So something as innocuous as a little fender bender could be very minor. You might have to pay a deductible to pay out for their policy to cover them, and it's going to cost maybe a couple $1,000s or something like that. But just as easily, you can rear end a Lamborghini just as easily as you can rear end a Camry, and the value of those vehicles is very, very different. You could rear end let's say a passenger van with 12 people in it, and they were all buckled up, but you hit them kind of hard, and so suddenly 12 people are going to the hospital, and maybe 6 of them were perfectly healthy and whole, but 6 of them were elderly or young, and they're more easily injured, and so suddenly their medical costs skyrocket. And that's just sort of a minor potential event where you might have tens of thousands or hundreds of thousands of dollars of claims that your common $300,000 policy isn't going to pay for. But then by extension, imagine a scenario in which you seriously hurt somebody, and not just an everyday person, but let's say a very successful high earning person. You accidentally hit a neurosurgeon riding their bike with your car, and their hands are broken, so now they can never practice neurosurgery. Their claim against lost earnings to try to sue you for in that circumstance is millions, tens of millions of dollars, depending on their age and their capacity and their earning potential. And your policy is not even remotely sufficient for that. So the trick here is the underlying assumption of insurance is often aimed at the average person, right? The average person is not a neurosurgeon. The average car is not a Lamborghini. The average vehicle does not have dozens of people in it who could be potentially injured by you. The average house does not have multiple people slipping and falling on icy sidewalks or down the stairs or anything like that. But you have to think about the extremes of events, no matter how unlikely, when we think about something like insurance. And so often the recommendation for people to get an umbrella is a recognition that, hey, you only have $300,000 of liability coverage here, or maybe you only have $500,000 of liability coverage very affordably. Let's say for $200, $300, $400 a year, we can add $1 million to that. We might even be able to add $2 million to that. And that's a lot more protection for you and your assets and your financial welfare in the event that, whether it's your fault or not, somebody decides to take you to court for something that's happened. You want some pretty deep pockets to protect yourself there, both in the legal defense, but then also in the case of an actual claim that ends up being settled or judged against you.
Hmm. Well, once again, I'm glad I asked. That's kind of a big deal.
Just a little bit. I will give the one disclaimer here. There is such a thing as being judgment proof, and this is just sort of a legal term, but effectively it just means there are people out there who are essentially too poor to sue. That is not a good game to play for yourself. If you are listening to a podcast like this, chances are you are probably not in the category of judgment proof. So just keep in mind, even if you think of yourself like, well, I'm just a school teacher, I'm just a software engineer, I don't have a lot of money, I'm not rich. That's great, but there's a big difference between being judgment proof, meaning you are essentially bankrupt in your day to day life, versus not having a lot of money, but still having potentially a lot of earning potential or a lot of career potential ahead of you, where somebody could be dipping into that for decades based on a small accident.
That's another good point. Okay. I have another separate question now, but this one's not for my personal life, I have to say. I was listening in on meetings again at work. Um, I'll be vague, but some people have moved from a different state to Colorado. And of course, it's pretty expensive to live here. And they were kind of in shock at the costs of both property taxes once they do buy, and just, of course, the sticker price of the house. And I've seen that with a few other people kind of having a hard time moving from one area to another and kind of readjusting expectations for price so they know what's a good cost. And, there still is unreasonable priced houses in this market, even above the average. How do you readjust those expectations when you move somewhere?
Well, the big thing around something like real estate is just fundamentally that it's a very high sticker price asset. And even if you're in a cheaper market where you can still buy houses for, $200,000 or something like that, when the price moves even a couple percent a year, you're talking about compounding of potentially tens of thousands. And if you're talking about more, northern Colorado pricing, where prices are often north of $500,000 for a single family home, you're talking about, 50,000, 60,000, $100,000 moves year over year, depending on the marketplace. And the consequence of that then is, if you sell out of one market and you move to a different market and you don't jump back in immediately, those costs as a percentage may not be very high. In a place like Boulder, which has famously expensive real estate, the rate of return or the rate of growth on real estate appreciation has only really been a couple percent every year. It's just that they were already kind of expensive to begin with, so those numbers are compounding. But then in a real dollar sense, right, you might say, oh, I sold my $500,000 house, so I could buy another $500,000 house, but I'm not gonna, in the immediate future. But come back 3, 4, 5 years later and find that a $500,000 house has grown to be a $750,000 house. This is not to say that when you sell a home, you need to run out and buy a new home. That's not really the point here, but you do need to really think about the fact that dollar values compound over time in a financial marketplace. And so when you jump out of a market and you don't have the money in something that adjusts for the inflation of that type of asset, so you take your money from the sale of a home and you don't reinvest that in another home, or you don't reinvest that in the market in a way to try to keep up with the pace of the home, you may find that your purchasing power for homes is declining, or that you have to spend a lot more money than you want to. The other phenomenon here is just the financial psychology term anchoring, which is we tend to think of things as more or less expensive than our initial data point. So, for example, when I bought my house, it was $645,000. And I think of that now as sort of the baseline for any home I will ever buy or sell again in the future. So, if I wanted to move to a similar house today, I'd probably have to spend $800,000 to $900,000. And if I wanted to buy a bigger home, I'd probably have to spend north of $1 million. And in my mind, I'm constantly comparing that to my home purchase price of $645,000. And everybody else is not going to be any different from that. If you buy a home at any price or sell a home at any price, you are going to then compare the price of other homes to that value. Now, the good news is for some people, they move from high cost living areas to low cost living areas where even if inflation's happening, the real estate difference is so substantial that they can still end up paying less. So then, even though their assets have gotten more expensive for purchase, they feel good about the exchange. But if you're moving from one high cost living area to another high cost living area, or from a low cost living area to a high cost living area, it really does behoove you to get really clear about your timeline for a change like that, and that you acknowledge the potential opportunity costs of staying out of that marketplace for a while.
There's not an average amount of time you suggest, is there? Because I've heard you tell people before if they're moving to a new area, you should rent for a little bit, make sure you do like it before you settle in and buy a house.
Ideally, I even think about that in two particular ways. I think there's sort of reconnaissance renting, where somebody says, like, hey, I think I'm going to move to Florida when I retire. My answer to that is great. Why don't you rent a place in Florida for a month or two and try living in Florida before you make that a permanent decision? On the other end, if you are relocating, period, you've got a job change or something and you're going somewhere else, I think it makes more sense to purchase a house sooner in that transition. It might make sense to rent as part of the transition and while you're shopping around. Also, just get a feel for the marketplace. Hey, do I want to live downtown or in the suburbs or on the north side, south side, whatever the case is? But the other part to that transition is that there's an element of how long you're going to live there. So, typically speaking, a home purchase is not likely to break even for about 5 to 7 years in what I'll call an average real estate transaction sense, because you have high transaction costs, high switching costs that are a part of that. And as an extension of that, a lot of your interest in a mortgage is also front loaded in terms of how the amortization functions. So, when you buy a home, you're never paying more for it than you are sort of on day one. And so if you're only going to be somewhere for a year or two, it does not necessarily behoove you to buy a home in that place if you know you're just going to be relocating shortly thereafter. If that means you have a home where you started before you moved as part of your career, and you're moving somewhere only for a year or two and then you're going to have to move again, the better solution for that might be to not sell your home or kind of your original home before you made that first move, but to try to just have it as a rental property so that it can appreciate and gain value. Now, there is a bit of an expiration on that. You do want to have lived in that property for 2 of the preceding 5 years. So if you've gotten out to sort of the 3 years out timeline and you're not looking at a place to permanently or long term relocate to, then a sale might make sense at that point for capital gains tax exemption reasons. But otherwise, in terms of wanting to just like sell a home, buy a new home immediately, you do need to want to live where you're moving to for a longer period of time in order to minimize your transaction costs and make a break even more efficient for you.
Sure, that makes sense. I have a question about that data point you mentioned earlier. Do you find that people's kind of idea of what something is worth resets if people buy what they call a starter home and they buy a bigger home and they buy bigger? Does that kind of move along with it? Or once you buy something that's such a high cost like a home, it's pretty set?
It really depends on how like the assets are. I think if you buy something like a townhome for, let's say, $200,000, you're probably not going to compare your then like marital with kids bigger house 4 bed 3 bath sort of place in the same sense. You're not going to, because you're gonna not going to think of those things as apples to apples. But if you're thinking about switching from a 3 bed 2 bath to another 3 bed 2 bath in the same town, you're going to have a hard time getting around that mental anchor to the original transaction. This is where you sort of get the weird comments from people who are in their 50s, 60s, 70s who will be like, well, like I bought a house when I was 22, and I would doubt almost anybody listening to this knows anybody who's 22 who bought a house or who has bought a house. And the byproduct of that is just recognizing, okay, there's a inclination here to make these sorts of comparisons, but real estate's what we'd call a thinly traded market, in the sense that each individual property is not traded every single day, millions of times a day. It's traded once every couple of years or every couple of decades. And so functionally, the price changes are going to be pretty substantial as time goes on, even in an asset that's not appreciating in any significant sense. And as a byproduct of that, a lot of people get a sticker shock switching homes over time. There's a whole separate conversation to be had here about interest rates and the costs of mortgages, but I think in that context, the purchasing power of a dollar tends to move on us whether we're paying attention or not.
I guess that's true. And that definitely tracks with what I've heard people say here, that clients we've worked with.
Fair enough. Well, then, you have been studying for your Series 65. So what is the most valuable thing you've learned over the last couple of weeks since you were last on the podcast?
Oh, let's see. I mean, most valuable is clear. It sounds a little obvious, but there's been a lot of material about don't lie to people, don't cheat, fraud is bad. A lot of material on that. So that's definitely the most important.
It's funny because I think everybody listening to this would just sort of roll their eyes and be like, well, no, duh. But I actually want to call out a specific element of that, which is investment advisors and registered securities people have sort of a tough reputation. There's plenty of bad brokers. You've got movies like Wolf of Wall Street and all sorts of stuff that sort of calls into question the professional qualifications and the ethics and the morals of the people who work in the financial industry. But I do want to emphasize something, which is there's a really big gulf between sort of the content and the nature of what registered, licensed investment advisor professionals and investment advisor representatives do with their clients, or what they share with the public, how they market the content they create and so on, and what unregistered or unlicensed people do. So for example, I have very little respect for how things like commercial real estate are marketed, or commercial real estate products are marketed in the private marketplace, because it will very casually do things like throw out, net operating income expected to be a 22% annual rate of return on your money. And that sort of language is incredibly tempting to the public, but is completely unacceptable in our space. And so I think, a relationship with the truth is a funny thing. Don't lie is sort of it feels like a table stakes requirement for a licensed professional, but I think it behooves people to remember in the broader marketplace for financial professionals, or just financial and investment opportunities in general, that not all players are regulated equally, and that the standards that they're held to are not all equal, despite the outward appearance that they're all doing the same thing. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.